As the election nears, it's worth taking a look at the tax side of what is being proposed by Donald Trump and Kamala Harris. Now, one of the major accomplishments that Donald Trump had back at the end of 2017 during his first reign was he had a major changes in the tax law. Now, because of the way budgeting works in Congress, these changes only last for 8 years, and after 8 years, they revert back. So in 2026, and in some situations 2025, a lot of these will revert back to the way they were back in the beginning of 2017. So this is a very important issue. Trump wants to continue what they're calling the Trump tax cuts, and Kamala Harris refuses to. Now, there's a lot of things that happened in that bill back in 2017, and it's worth noting one of the big ones was a massive increase in the standard deduction, which is how much the taxpayer can just subtract off his taxes. And it went from, I believe, around $6,000 up to right now it's at almost $15,000. That's a standard deduction. You don't have to explain or defend it. It used to be if you went over the $6,000, you had to itemize it and only applied to certain characteristics. Okay, so that's a big change. Now, Donald Trump has proposed several new, very exciting tax breaks, particularly targeted for the lower and middle income. How will these affect the tax situation? Well, the first one he's talked a lot about is no tax on tips. The IRS has actually rolled out a very aggressive campaign requiring employers to report all tips being given. So this is a brand new campaign. It had new systems to track this, and it just got rolled out this year. So this is a very hot button. Now, no tax on tips is big. Now, think about it. Tips are going to be representing in the neighborhood of 10 to 20% of a person's income. These are waiters and waitresses, typically not on the higher income scale. So they're going to be on the lower income or maybe lower middle income. So, they're ones that are going to benefit from this. It actually would reduce your taxable income. Secondly, he's talked about no tax on overtime. I'm not particularly sure how this would play out, but I guess after you've been taxed by a certain number of hours as an hourly employee, there wouldn't be an additional income tax on that. That's an interesting wrinkle. Again, it's reducing the taxable income that you're experiencing. Now, I shall say this, 47% of all taxpayers don't pay any taxes at all or get money back. And why is that? Because there's lots of credits, especially child care credit, earned income credit. So a lot of these things related to no tax on tips and no tax on overtime actually may have no impact on the regular taxpayer if he's not paying taxes already. So, that's one thing to consider. It certainly is a step in the right direction in terms of equity, if you aren't able to take advantage of those various credits. Another big item he added was the ability to write off interest on car loans if it's an American-made car. Now, interest on these car loans only come to bear if you're itemizing deductions. So you'd have to have deductions that took you over the $15,000 standard deduction before you really got to have a benefit of it. But it's clearly the type of incentive that is addressed to the general need of people, that the taxes shouldn't be punishing the average person. So I think it's sensible, even if the impact of it may be limited. The next thing he proposed was an elimination of the tax on Social Security. Well, the way the Social Security tax works in the U.S. is that if you make over a certain amount, and I think it's in the neighborhood of $36,000 from all sources of income, then you are taxed on 85% of your Social Security. So it's treated as taxable income. Now, this was something that President Clinton rolled in, and the idea is if somebody's making Social Security, but they're also got investment incomes and this and that and the other thing, well, hey, they've pushed everybody into 401ks and retirement plans. So yeah, for sure, you're going to have a lot of other income besides your Social Security. So it's kind of wrong to tax you. And in my opinion, you already paid tax on that Social Security money when they took it out. All right. And now they're taxing it a second time. And you're taxing seniors. I mean, come on. Why do we tax the seniors and then try to create benefit programs for them? Now, Kamala Harris is saying that she wants to add a tax on the unrealized capital gain. This would be a 25% tax. Now, this is a very harsh tax. Many important people have said that this would destroy the stock market, could destroy many other investments. If you're taxed on unrealized gain, well, where are you going to get the money to pay the tax on gains that you haven't yet realized. Well, you're going to have to sell other assets to pay those taxes. Whereas the current program, which people find is equitable, is you pay tax only when you actually experience a gain, when you've actually sold something. And for crypto investors, this is very massive because many crypto investors would have to pay lots of taxes every year and track them when they have to be reversed if it's a loss in a particular year. It's just a complete nightmare to track. All it is stealing from the future to pull money into current years. It doesn't generate additional revenues because ultimately it has to be tied out. So the whole system is just destructive to the investment without bringing in substantial income on the long haul to the U.S. government. Make sure you vote.